Hello and welcome to Sovereign Financials, financial education for everyone. Hi guys, welcome back to Sovereign Financials. Today we're going to talk about what Glenn Kelman, who's the CEO for Redfin, is calling the perfect storm for the housing market. He had an interview with CNBC on October 16th in which he stated that due to the increasing price of homes, as well as the increasing interest rates, and home price increases that are faster than the median income, that we're creating this perfect housing storm for the house price crash to come. He also mentions that basically home prices are increasing faster than people's income are, therefore making it unaffordable. You compound that with mortgage rates that are increasing, and the Fed continues to plan to increase interest rates, which then makes mortgage payments unbearable for people. And an increase in the housing supply can all kind of lead to a downturn in the housing market. So I can't play this film for you because it's on CNBC, probably some copyright issues, but go to the website, check it out. It's only about 3 minutes long and it's very informative. The first article I want to take a look at here is on Bloomberg. They say housing market is raising serious red flags. Real home price growth looks to have already entered a cyclical downturn that is likely to intensify as affordability worsens. If we come down here lower in the article, it says despite a robust U.S. economy, at least measured by GDP, real home price growth is locked in a cyclical downturn, and it will likely get worse based on the same approach and factors that correctly flagged the housing bust in real time in early 2006. So if we come a little bit lower in the article, first of all, it says U.S. leading home price index growth, and you can see that the home price index growth is actually decreasing. So we're at negative 1% now in terms of home prices. So if this is growth is going up, that means home prices are going up. But since it's going down, that means the growth of home prices is declining, and then therefore later on entering negative territory. So part of the reason for the worsening outlook in home prices is the plunge in housing affordability. The metric from the National Association of Realtors Housing Affordability Index recently dropped to a 10-year low, partly as a consequence of rising mortgage rates, which I mentioned earlier. As interest rates are now hitting 5%, you multiply that by the house price, and mortgages end up being very high. And then, just like the CEO of Redfin said, there's also been an undercut by the steady rise in the ratio of median existing home prices to the median earnings of full-time wage and salary workers, meaning that home prices are growing faster than workers' income is, and therefore getting too expensive. So housing affordability, if you take a look here, it was increasing up until 2013, 2014 area, and since then housing affordability has been on a decline. And this is current data too. This is past somewhere in mid 2018. And if you come down here too, something else is interesting is the home builder profitability is caught in this pincer between falling home price inflation, meaning home price increases, and rising building cost inflation. And this is a lot to do with the trade wars that we're currently having with China, so higher steel tariffs as well as other building materials. So this is Bloomberg's America's Home Builders Index. So if you take the companies that are out there building homes and you look at how profitable they are, this is basically an index of how much money they're making, how well their stocks are doing in the US stock market. And you can see that January 2018, which I was previously calling as probably the top of the housing bubble, you can see that the home builders income, or how well they've been doing, is going down, and therefore the stocks of the home builders has gone down as well. The first graph I have here is of Toll Brothers. Toll Brothers is a company that makes homes, and once again you can see here, so here is the beginning of 2018, January, and you can see that their stock has greatly declined, and these people's stocks decline as their revenue and earnings go down and their long-term outlook goes down as well. So home builders are in decline there. That is Toll Brothers. Another company here, which is known as KB Homes, you guys are probably more familiar. It's a pretty big company, if not the biggest. I don't know if it's second to Toll Brothers or not. But you can see here, once again, a peak in 2018 and early in January. And since then, their stock has been performing really bad as well. Now, they're making money. If you can see here, this is their revenue. And you can see their revenue is actually not doing bad. In total, they're making a good amount of money. But their earnings has been dismal. Almost non-existent. So the actual amount of profit they're making is very low, and that's because their building cost is so high. Another stock market here I want to show you, or a fund I should say, is the iShares US Home Construction ETF. It's an exchange traded fund, so this iShares company puts a bunch of these home builders into one fund, and then you can basically buy shares of this and therefore end up owning multiple home builders stocks. And you can see here once again, if you take a look, 2018 January is kind of the peak. It took a dive since then, and then more recently it took a massive dive right here. So home builders are not doing well in this market. And if you take a look at the ETF, this was around before the 2008 market crash, or 2007, 2008 market crash. So if you come across, they've been doing well for quite an amount of time here. But if you look at the last peak was actually in 2007, which is a little bit after the peak of the housing market, and you can see how they crashed after that. And this stuff here is kind of similar to what they're experiencing right now. This here looks at United States housing starts, basically how many new homes are being started. Its housing starts dropped by 5.3% from the month earlier. Now, 5.3% isn't really that big of a drop in housing starts, so I want to show you the graph here, but it is just kind of along with the rest of the information, kind of showing this downtrend of house buildings and affordability and everything else that we'll talk about in a little bit. But you can see here that after the crash, housing starts were going up, they're building some homes. It looks like it might have topped off here. And then the question is will it head down or not from here? We'll have to kind of see. But no matter what, you can see that we were way higher in 2005, 2006 than we are now. So housing starts, I'm not really too negative on the outlook of this, but I kind of just wanted to bring it up because it is kind of going along with the rest of the information. So this is the monthly supply of houses in the United States. Everyone's talking about the supply rut that we've been in for a while, which is very true. However, this number has been going up. So in August, the monthly supply of houses, the index is at 6.1. And that's where we are right now. So you can see that the supply of houses has been going up here. The question will be, will that continue? And if you look, since 2011 or so, we've kind of been increasing here, which is good for people that want to buy homes. The other thing that is interesting is if you look at as the supply of houses in the United States goes up, that usually indicates when we enter a recession. So if you see here, we went up, and then the gray bars is recession. It went up, and then the gray bars is recession. Went up, recession, recession. It started going up, recession. This one did not right here lead to a recession. This is a very minor increase, which is recession. This is mainly a stock market recession than anything else. And then if you look here, it started going up, and then this is the 2007, 2008 recession. And if we draw a line straight across here to here, we see the last time we were at these levels was roughly in 2006, which is the top of the bubble. And then we didn't get into the recession territory or the peak of the housing supply until 2007, 2008 timeframe. But if this trend continues here, I would imagine this thing to start spiking, us be declared to be in a recession, and then housing supply would spike up here. This next article is in the Washington Post, cities where the supply of homes for sale is growing and shrinking. Because there's somewhere the housing supply is still shrinking, but a lot of places it's been increasing, especially along the West Coast. I just want to bring up one little thing here. It says the number of new listings rose by 8% in September, according to a new Realtor.com housing report. It talks about some of the areas down here increasing by 30% or more, but there's a better article that actually gives us the specifics of that one. So this article here is from Cubed. It says home prices have finally hit a wall on the West Coast. And I'm not trying to ignore the East Coast here, and I'm not trying to ignore Texas. I want to talk about Texas a little bit because I know you guys have been wanting me to talk about that for a little while. But maybe next week I'll talk a little bit more about the East Coast and New York. So in this article here, it says home sellers have had it easier over the last few years as housing demand has increased with an improving economy, and home builders have struggled to build at the pace that keeps up with demand, thus resulting in a housing shortage. But data from the last 2 months suggests that the housing market is entering a new stage, especially along the West Coast, where home prices have risen beyond most people's capacity to pay. Instead of bidding wars, houses are sitting on the market longer and price cuts are becoming more common. Buyers are starting to regain the upper hand. If we are right, nationally, we've already entered the early stages of a buyer's market. Should supply levels cross above 5 months, we'll be watching for a flat or possibly declining resale prices in some markets, especially where affordability is already very outstretched. And then here, data from the National Association of Realtors shows that months of supply, a leading indicator of housing supply that divides the number of active listings by the pace of sales, has ticked up year over year in the past few months after years of decline. So let's take a look at the graph here. So months of housing supply in the US year over year. This is basically just a measure of how many houses are on the market and available for buyers. And if you look, since 2015 all the way till early 2018, essentially the housing supply, this is all negative, right? This is not a good percentage. But starting in right around past like 2 or 3 months, we've had this increase in the housing supply. So this is a big trend change. We had one little spike back here in 2015, but other than that, housing supply has been very limited, and now housing supply is starting to kick up, which could put us back in the buyer's market. So some of the biggest jumps in the markets have been red hot over the past 5 years, namely San Francisco Bay, Seattle, and Denver. Active real estate listings in September were up by a whopping 113% year over year in San Jose, 81% in Denver, 47% in Seattle, 33% in San Francisco, 34% in San Diego, and 12% in Los Angeles. And then of the 30 markets that showed the highest spikes in active listings September 19 are in those 4 states. So, unfortunately, California, Colorado, Washington, and Oregon, those are the places that have had the biggest areas in increases in home supply on the West Coast. Down here in the article, it says this is a sign of weakening demand relative to supply, particularly when you see multiple months of decelerating home price appreciation. So if you look here, this is the housing market data for the West Coast in September. So this is the year-over-year increase in active listings. So everywhere, essentially along the West Coast, has had more listings. There's more homes for sale. Sales volume, essentially everywhere, is down, except for there's a very, very few exceptions where sales volume is increased. And the year-over-year change in the rate of home price appreciation essentially is down everywhere. So home prices at least are not increasing as fast as they used to be. And then I've showed you in previous videos that actually in a lot of markets, the home prices are actually decreasing. The other important part here is the 30-year fixed rate mortgage. So as you can see, since 2017, we've had an increase in the 30-year fixed rate mortgage, and we're actually approaching the 5% area, according to this graph. Now, some lenders are actually already at 5%. The problem with this is that expensive homes multiplied by a high fixed rate mortgage makes it so payments are unaffordable. So people aren't able to afford the houses, and then people that are selling their homes have to decrease the price of the homes so that the price of the homes at the 5% interest rate creates affordable payments for people. So as mortgage rates increase, this will lead to decreasing home prices as well. This article here is from therealtor.com that mentioned in a previous article. So this is just a little update here. It says Freddie Mac mortgage rates. This is something they were looking at from last week. So Thursday, Freddie Mac data was out for mortgages. Mortgage rates increased by 19 basis points, which is 0.19% from the previous week. This is the largest jump since 2016. That itself is not that impressive. However, the interest rates are at 4.9%, which is getting up there closer to 5%. And then looking forward, we expect momentum could push Freddie Mac mortgage rates up to 5% next week. Although 5% mortgage rates are historically low, crossing this threshold could have a sticker shock effect on some buyers currently in the market. We could see some buyers, especially first-timers, leave the market in the next week as a result. The next topic I want to look at is mortgage applications, so people that are actually attempting to obtain a loan for a mortgage. So weekly mortgage rate applications tanked 7.1% as interest rates surge to a near 8-week high. This is in CNBC. The total mortgage rate application volume fell 7.1% for the week, according to Mortgage Bankers Association. Some other stuff here too is applications to refinance a home loan fell 9% for the week. And then Treasury rates increased over the week, mainly as communication from the Federal Reserve officials point to a continued path of rate hikes, which we've talked about before. There's already basically a guaranteed rate hike in December, so we'll see how that goes. And then, as I had mentioned, that interest rates are already 5% in some locations. So the average contract interest rates for 30-year fixed rate mortgages increased to its highest level since 2011 at 5.1%. And like I mentioned, as that gets up there, people won't be able to afford houses and home prices have to come down. So more importantly about the mortgage application, not only did it drop 7 to 9% for existing homes or refinancing loans, but if you see here, this is where we're at. This is a mortgage application index, and we're down here. Now, it did touch that in 2014 and technically touched it once in 2015, just barely for a very short period of time. But other than that, the last time we're at this level was all the way back in 2001 after the dot-com bubble. We didn't even get this low in mortgage applications during the 2008 crisis. And this was just small little spikes that came down really quick and then bounced back up. But you can see here that mortgage applications are right now currently in a downtrend. All right, so for the people that have been asking me about Texas, this is the Houston housing market cools in September. It's not that great of data because, well, I'll tell you why in a minute. But total property sales, not including just single family, but single family, multifamily, etc., the property sales are down by 4.4%, so that's kind of good. Total active listings is up by 5.7%, which is good, so there's an increased supply. The average sales price, unfortunately for you guys, is up by 1.7%, and this is comparing 2018 and 2017. The inventory, which is good for you guys, was gone up. So there's 3.9 months, now there's 4 months, so a slight increase, not much, but a slight increase. Now, why is Texas home prices going up, and do I think that the home prices in Texas will come down? And unfortunately, I don't think they're going to come down yet. I think West Coast and East Coast have to fall greatly before the Texas or essentially the middle part of America, like central time zones, come down. And the reason for it is this: is people are leaving expensive areas. So this is the top 10 counties with the highest 5-year net outbound migration. So where are people leaving? People are leaving Los Angeles, California, New York, New York, New York, New York, California. So people are leaving California and New York. And where are they going? Right? They want cheaper houses. So where are they going? Texas, 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 Texas. So as people are leaving the West and East Coast and going to more tax-friendly areas and places that aren't as expensive to live, Texas is getting a huge inflow. Obviously, some other people are going to Arizona. I believe this is Nevada. If it's not, Nevada is another big one. So people are going to places that are cheaper. So I think that as home prices come down, people will leave the West and East Coast and head to Texas until the entire market comes down. Then Texas might have a better relief in their home prices. This is a more of a graph showing the same thing here, or a picture, I should say, of it. You know, people are leaving the West Coast, people are leaving the East Coast, and look at this, like people are going all over Texas. That's like one of the biggest spots people are going, you know. And what's interesting is, according to this graph here, is this is for the reasons for why people are leaving, and the migration is housing related in 55% of the time. So people are definitely going to Texas right now because housing is more affordable. You know, work related is only 18%, family related 16%, and other reasons 11%. But if you look at the big chunk of the pie here, it's basically homes are too expensive on the West and East Coast, so people are headed to Texas for now. All right, guys, thanks for coming back. Appreciate you watching the video. If you liked it, I would love it if you can come down here, hit the subscribe button, like, share it with your friends, and I'll see you next week. All right, thanks. Bye.